Hello everyone, let's provide you with a brief overview of long-term assets. Long-term assets are resources owned by the company that will provide value for more than 1 year. Long-term assets are sometimes called non-current assets or fixed assets. Long-term assets can be tangible or intangible. Tangible assets are physical assets. You can touch them. Tangible assets include equipment, buildings, vehicles, furniture and fixtures, land, and natural resources. Intangible assets are assets with no physical substance. Intangible assets include patents, copyrights, franchises, trademarks, and goodwill. Because long-term assets provide the company with a benefit beyond the current year, the cost the company incurs to acquire, develop, or improve these assets is said to be capitalized instead of expensed, which allows the company to allocate the cost over the periods benefited. Financial terms used to allocate the cost of long-term assets include depreciation, depletion, and amortization. Long-term assets like equipment, buildings, vehicles, furniture, and fixtures are also referred to as property, plant, and equipment, or PP&E. Allocating their cost is referred to as depreciation. They have their costs depreciated over the asset's useful life. It's important to know that land is a long-term asset, but it's a non-depreciable asset. Unlike equipment, buildings, furniture, and fixtures, land doesn't wear out or become obsolete. It is said to have an indefinite useful life, and as such, it is not depreciated. The process of allocating the cost of natural resources like coal, oil, natural gas, and timber as they are extracted from the earth or used up is referred to as depletion. Except for goodwill, the cost of intangible assets are amortized over the life of the asset. Goodwill is tested for impairment consistent with accrual accounting. In the matching principle, depreciation, depletion, and amortization are also known as DD&A. They're methods aimed at matching the cost of the asset with the revenue they help generate. All three expenses are non-cash expenses that appear on the company's income statement. As you study long-term assets, you will learn how to determine their acquisition costs, record expenditures after the acquisition, allocate their cost over time, prepare the periodic adjusting entries, record the disposal of long-term assets, and present long-term assets and their related expenses on financial statements. Let's look at each of these topics individually. First, let's look at acquisition cost. The acquisition cost of long-term assets will always include the purchase price and all costs needed to prepare the asset for use. Expenditures after acquisition will be capitalized and then depreciated if they serve to improve the asset and increase future benefits. Costs will be expensed if they only benefit the current period. When it comes to allocating the cost of long-term assets, we will focus on property, plant, and equipment and introduce you to three depreciation methods: straight line, declining balance, and activity-based. The components needed to determine depreciation are the original cost, the estimated useful life, and the salvage or residual value. The salvage or residual value represents what the business expects to receive from selling or disposing the asset. At the end of each accounting period, an adjusting entry for depreciation will be made along with the other adjusting entries the company makes. The adjusting entry will always affect the accounting equation by decreasing the book value of the company's assets and decreasing stockholders' equity because of the increase in the company's operating expense for the depreciation of the property, plant, and equipment accounts. The adjusting entry will always debit depreciation expense and credit accumulated depreciation. The use of accumulated depreciation allows companies to maintain a record of the asset's acquisition costs while tracking the amount of depreciation expense that has been recognized over time. Accumulated depreciation is a contra-asset account, meaning that it is subtracted from the asset's acquisition costs to determine the book value of the asset. Once an asset reaches the end of its useful life, it is either sold, retired, or exchanged. Disposal of a long-term asset will result in gains if the asset is disposed of for an amount that is greater than the book value. On the other hand, a loss will result if the asset is disposed of for an amount that's less than the book value. The financial statement presentation of long-term assets and the related accounts will list depreciation, depletion, and amortization as operating expenses on the income statement. Any gains or losses that are taken on the disposal of the long-term asset will be reported as a non-operating item on the income statement. The acquisition cost less the accumulated depreciation will be reported as property, plant, and equipment net in the long-term assets section of the balance sheet. The cash flows related to the acquisition or disposal of long-term assets will be reported in the investing activities section of the statement of cash flows. That's it. This brief overview is designed to provide you with the basic concepts related to long-term assets. The life cycle of long-term assets includes the acquisition, subsequent expenditures, cost allocation, and then disposal. I hope this helps you understand this topic. Thanks for taking time to watch the video. Good luck.